Now that the One Big Beautiful Bill has passed, does this mean that we can put taxes on the back burner and focus on other things for a while? Sadly, it does not. We've still got to keep taxes front and center because we want to make sure that we make the best use of this opportunity that we have in order to be sure that you're going to be in the best position long term and when your kids inherit your money. Now, this bill did make some changes that are going to be helpful and beneficial. For one, it made permanent the lower tax brackets that were put in place under the Tax Cuts and Jobs Act. Now, when I say permanent, I mean until tax law changes again. But for now, they're not going to automatically expire. We had been planning around the fact that they were going to expire at the end of 2025. They do not expire, and they will continue into the future, and we'll be able to use these lower tax brackets to do the planning that we're doing. The bill also made permanent this higher standard deduction. Tax Cuts and Jobs Act had basically doubled that deduction, the standard deduction, and that allowed more of you to use that instead of trying to itemize and keep up with records and try to beat that lower standard deduction. That higher standard deduction was beneficial. It's now going to continue until tax law changes again. It also added an enhanced senior deduction. And I did a separate video on this, so you can find that here on this page someplace. But this enhanced senior deduction is an additional $6,000 per person if you're over 65 and your income is below the thresholds. It also added an above-the-line deduction for charitable giving. So that's an $1,000 above-the-line deduction if you're a single filer, $2,000 above-the-line deduction if you are married filing jointly, and that reduces your adjusted gross income. Above-the-line deductions are very good because having a lower adjusted gross income then means that impacts how much of your Social Security is taxable and what capital gains bracket you're going to be in and how much you're going to pay tax on your dividends. So it impacts a lot of different things through that flow-through effect of the adjusted gross income. So those are good. Those are all very good. And they allow you to save taxes this year. But what I want you to think about, do not lose focus on your long-term tax plan. You've got to keep a focus on what is your lifetime tax bill. Because saving taxes this year that ends up costing you even more in tax down the road isn't a good balance. If you want to lower your lifetime tax bill, you've got to think about how much tax should you pay this year versus how much tax you're going to pay later to have a good balance. Keeping yourself in lower tax brackets over your lifetime. Sometimes people lose sight of that and they begin to just try to save as much tax right now, not realizing that they're going to put themselves in a position down the road where they're going to pay a whole lot more tax then because of how big those required minimum distributions become. So you want to think about your tax bracket this year, your tax bracket over the coming years, the tax bracket when one of you is a survivor. So the first spouse has passed away because there's a big jump in tax cost at that time. And then the tax brackets your kids are going to be in. You also want to consider the possibility that tax rates can go up. What is the risk that tax rates go up during any of those points in time? And I would say it gets higher the further out we go because we can't run on a low tax bracket forever. We have got to have a way of funding the cost of our government and the government debt and all the different things. And so we will have higher taxes at some point in time. How that's going to play out, we don't know. But what I do know is that right now, we've got some lower tax brackets that you can take advantage of. And you can use those to do the best planning that you possibly can. Minimize this year's tax, but not at the expense of future tax. Try to come up with a good balance between the two. Think about how much capital gains you should trigger, how much Roth conversions you should do, what other income sources you have coming in, how you should take them, when you should take them, all the different things that go into making a good lifetime tax plan, so that when you get down the road or when your kids inherit, you've got the best results that you could possibly have in your situation. Think about that. If you need some help, have some questions, feel free to reach out to me, and I want you to be on your best path in your retirement.